All right, so now we're going to finish up chapter 3 and talk about home loans. I know the title in the section actually talks about home loans and student loans, but we're going to ignore the student loans because they can just get quite a bit messy, at least for what's necessary in this class. So what do we have? First thing, mortgage. That's a long-term loan where you're putting up the house you want to move into as collateral. So if you stop making payments, then they take your house. Mortgages are typically 20 or 30 years, but can be as short as 10 or as long as 50. Mortgage comes from the French for death contract, which is always fun. So why is it called that? Well, because they're long, right? They're particularly long. 30-year loan, 20-year loan, those are pretty long term. Now, there's two types of mortgages. You can have a fixed rate mortgage, which is what you should always aim for if you can get it. Fixed rate mortgages, once you settle on the interest at the beginning, that's it. It's the same interest rate for the entire life of the mortgage. If it's 20, so now it's 2023. If you got a loan in 2021 at 3%, now going rate's 5%. You're sitting really pretty as long as it's fixed rate. Now, if you had an adjustable rate mortgage, that means that at a later date, the bank or whoever holds your mortgage can increase the interest rate. So why would people do that? Well, the reason you do that is an adjustable rate mortgage is easier to get at the beginning, and then the interest rate can move with time. This is one of the things that caused the housing crash, 2007, 2008. Is a lot of people were buying adjustable rate mortgages, so they'd have a couple years of low interest, and then the interest rate would balloon. So you've also called balloon mortgages, and then it would just become it would get to the point where the interest was so high that the person couldn't make the interest payment, much less the interest and the principal. So how do we figure out monthly payments? We use this formula right here. Mortgage is, and this is fixed rate, in the numerator I got the principal times the rate over the number of compounds per year. For mortgages, that's almost always going to be 12. N is the number of payments in a year. So yeah, you could swap these out for 12s. 12, 12, and 12. All right, I've never heard or seen a mortgage that was structured to have pay quarterly or bi-monthly or semi-annually or anything weird like that. So it's usually a monthly payment, so 12 a year. So here's an example. The Petty's family plans to buy a home for $224,900. They've been offered a 30-year mortgage with an interest rate of 5.5% if they make a 20% down payment. Now, that is absolutely critical. There are other features in home loans that are not being mentioned here, but if you can make a 20% down payment, what that does is it helps you avoid primary mortgage insurance. So if you are planning or thinking about or in the future considering purchasing a house, if you can make that 20% down payment, what you're going to do is prevent yourself from having to pay primary mortgage insurance, called PMI. And the reason you want to avoid it is primary mortgage insurance is there. It's insurance you have to purchase to protect the borrower, to protect the lender, because if you can't make a down payment to start with, or you can't make a sizable down payment, you're more likely to default on the loan. So if you can make that up front, you avoid that. So primary mortgage insurance is exactly what it sounds like. It's insurance that you have to pay for to borrow the money to buy the house. Once you get to 20% down, you can usually get rid of it. This also happens in car loans. It's not called primary mortgage insurance there. It's called gap insurance. And for cars, the reason you'd have gap insurance is because if you take a car off the lot, pay $30,000 for it. They always say as soon as you drive it off the lot, it loses 15-20% of its value. So if you crash it early, you paid $30 for it, and let's say you crash it a couple months later, that car totaled is only going to be worth $25,000. And now there's a difference between how much insurance is going to pay for your totaled car and what you paid for it. So the difference in there is the gap. So if you don't make a sizable down payment on a car, you may be encouraged to purchase gap insurance. If you get gap insurance or you get primary mortgage insurance, once you have made 20%, once you pay 20% of the principal, contact the person, contact your the bank, whoever holds your mortgage, whoever holds your car loan, and let them know I'm ready to get rid of the primary mortgage insurance. I'm getting ready to get rid of the gap insurance. So just a small little aside for me. So I'm asked to calculate the down payment and how much the petty family is going to have to borrow. Well, the down payment is going to be 20%. So I need to find 20% of the house price. So $224,900. I want to find 20% of that. Put that in the calculator. I'm looking at $44,980. So that means how much are they going to have to borrow? 224,900 minus 44,980 is 179,920. Or if you like, if they're going to pay down 20%, that means they're going to keep 80% of it, right? So I can find this. So what did I do here? I took my price, I subtracted 20%. If your brain works different ways, you may see this as keeping 80%. So what's 80% of 224? Well, it's the same thing, 179,920. So that is the amount of money that's being borrowed, because the petty families put down almost $45,000. Now, we don't show you the calculation of the monthly payment here. We just tell it to you. It's $1,021.57. The question is, how much money are the petties going to actually pay for their house if they make monthly payments and don't make any extras? So this sounds familiar because from the car loan, this is the total installment price. And the total installment price is all payments, and to be clear, monthly, plus the down payment. All right. All the monthly payments. Monthly payments are $1,021.57. And I'm making 12 of those a year for 30 years. 12 times 30 is 360. That's going to give me how many monthly payments I do, plus the down payment. The down payment was $44,980. Monthly payments all put together is $367,765.20. Plus the down payment comes to a total of $412,745.20. That is your total installment price. That's what you're going to pay for that house. All right. So the question didn't ask this directly, but let's figure out the finance charge. Or in other words, what did you pay in interest to move into this house early before you actually paid it off? Well, that's the total installment price minus the price, $224,900. And amazingly, you have paid $187,845.20. Now, I want you to, okay, that's less than the price, right? But look at how much you borrowed. How much did you have to borrow for this house? You borrowed $179,920, and then you paid $187 in interest. When you use a 30-year mortgage, you are almost inevitably going to end up paying double what you borrowed back in interest. It's it's a crazy thing. You only borrowed 179,000, 5.5% interest for 30 years, but after those 30 years, you're going to have paid back 187,000 just in interest. That's not what it cost you. You paid all of this plus all that you borrowed. All right, so keep that in mind. If you can afford a shorter term mortgage, absolutely go for that every time. If you can make a larger down payment, go for that every time, and then get the lowest interest rate that you can.